This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. Your top stories this hour.
Tosca, Motovesa Tosca, vacate your engine room. Vacate your engine room. We're prepared to subject you to disabling fire.
Oil jumping at the Asia Open as the U.S. Navy attacks and seizes an Iranian-flagged cargo ship in the Gulf of Oman. Stock futures turning lower as traders assess a chaotic weekend in the conflict. President Trump again threatening to destroy Iranian power plants and bridges if negotiations fail, with Tehran casting doubt on a second round of peace talks. And the UAE reportedly seeking a U.S. financial backstop in case the Iran war inflicts major damage on the energy-rich Gulf state.
It's been another dramatic weekend with really the optimism from last week, with the S&P 500 rallying to a record high, not lasting after the Iranian ship news came out that it was seized by the U.S. Navy, not to mention, of course, the mixed messaging that we're getting when it comes to the course of this war. So early in the Asian session already, we have some upside for the U.S. dollar, and risk-sensitive currencies like the Aussie dollar leading the decline. So it's a pretty shaky setup for the Asian session. We're seeing Nikkei futures now pointing to the downside of more than 1% after already a session of losses on Friday. We have some more weakness on the Japanese yen as well. A lot to do with what markets are gauging from commentary coming from the Bank of Japan Governor Ueda, who did not give a clear signal of where rates could go later this month when they announced their policy decision. We do have a couple of policy decisions also from central banks of the Philippines, Indonesia as well. No change expected from them, given, of course, the caution as the Iran war continues into its 7th week. When it comes to the bond space, it'll be crucial to watch Tuesday's Senate confirmation hearing of Kevin Warsh as Fed chair, as we continue to hear Fed speak about where the war could go and what that could mean for the economy. Take a listen.
Abstracting from the effects of tariffs and energy, I see a forecast in which underlying inflation continues to move toward 2%, leaving me cautious about rate cuts now, and are more inclined to cuts later in the year to support the labor market when the outlook is more steady.
Of course, Shery, this is coming at the time where Iran's reversal on allowing transit through the strait alongside the ongoing U.S. blockade. These latest developments effectively leave the waterway shut. And Brent is reacting this morning. We're popping back towards the 96 handle. And don't forget, we were roughly 90 on Friday amid these hopes that there would be an end to the war or a full reopening of the strait, or the potential, the prospects of that. We're also seeing WTI surging. Note as well how Brent's premium over WTI remains high, and this is at higher levels than pre-war, certainly. We are also seeing gas prices reacting to the latest development, though note at this time of trading, volumes are thin. We are also watching out for how treasuries react today, especially given how the energy prices seem to be setting the tone for U.S. treasuries and debt overall. Let's get the latest on the escalation of the Iran conflict with Bloomberg Politics editor Laura Davison. Laura, how did things unravel in such a manner, and are we back to square one?
It really does feel like Groundhog Day, and that we are in a situation we have found ourselves many times where we're up against a deadline. This time, the ceasefire set to expire on Wednesday morning in Asia, and tensions are really at almost an all-time high here in this war. You had Trump come out on Friday and say that a deal had been struck and that the Strait of Hormuz would open over the course of the weekend. It became clear that none of that actually came to materialize, and in fact, these peace talks that Trump is talking about taking place in Islamabad, Iran is not even sure that they're going to send a delegation to them. So, lots of different pieces here of the Strait of Hormuz. We have a situation where you essentially have both Iran and the U.S. sort of wrestling control, saying, no, I'm blocking it. No, I'm blocking the strait. So this continues to remain closed after a brief moment of optimism that it would be open. We saw Iran fire on a UK-linked ship, as well as the U.S. seizing an Iranian cargo ship that was transiting through the strait, blowing out their engine room and boarding that ship as well. So we have a lot of confusion, a lot of sort of escalation, and potentially a breakage of the ceasefire, depending how both sides see it.
Laura, you just read my mind calling this Groundhog Day. That's exactly what I told my producers earlier today, because it seems we're just talking about the same points in the last 7 weeks of the war. Mixed messaging. We don't necessarily know how the negotiations are proceeding. One thing that caught my eye, though, reports from the Wall Street Journal that the UAE might be asking for a currency swap line. How significant is this, given that it seems at least Gulf states are expecting perhaps more deterioration instead of President Trump's optimism that the war will be over soon?
Yeah, this is a real reality check coming from Gulf allies saying, hey, we are not sure that we can hold on much longer. And they're turning to the U.S., who they see as sort of responsible and the instigator of this war, to say, hey, we're going to need help if we find ourselves in a liquidity crunch. The UAE has, said that they've been able to sort of weather the storm so far so well, though, among one of the economies most affected, they've not been able to sell oil to the broader world passing through the Strait of Hormuz. And we could see this start to spiral and escalate if other countries also start making similar asks. Really an indication that they don't see this war ending anytime soon.
Laura, reality check also in terms of prices at the pump. And we have the U.S. Energy Secretary saying we might not see prices back below $3 until maybe next year. What is this going to mean for, until the events of the weekend? We were expecting the U.S. president to, in a way, refocus to domestic political issues. What's the latest on that front, then?
Yeah, this is, we know Trump would love to pivot and talk about domestic political issues, but the economic reality and the geopolitical reality is that Iran is continuing to dominate. We've heard the administration say that gas prices would go down quickly. Then we heard late last week from Scott Bessent, the Treasury Secretary, that by September, and now we're hearing from Chris Wright, not until next year. So this is really sort of, just in the matter of days or weeks, sort of the evolving thinking with inside the White House on how long this could last, what the economic strange could be. That's a real red flag for Republicans heading into the midterms, where they want to be talking about affordability and the low price of gas. That was a big talking point for Trump before this war began. Now it looks like that will not be something that they'll be able to tout, and potentially they could lose seats both in the House and Senate, giving Democrats back control of Congress.
Laura, thank you so much. Our Bloomberg politics editor, Laura Davison. And let's get some analysis now. Randa Slim is senior fellow at Johns Hopkins University School of Advanced International Studies, and she joins us now. Randa, always good to see you. So we had Laura just talking through some of the latest developments. What's your read on the situation and the extent in which this maybe moves the needle in some way and tells us more about what Iran has in terms of leverage versus maybe what the U.S. has at this stage?
Well, definitely the seizure of the Iranian ship has complicated the situation that's already complicated, and already we are hearing from the IRGC, the Iranian Revolutionary Guard, saying that they are going to respond to this latest escalation. So for Iran, the question is going to be the window of time. How much can they continue with this war for both parties? I think we are hearing competing narratives now from both of them about the talks. The Americans are saying they're sending their delegation to Islamabad on Monday. Immediately after the announcement, the Iranian IRGC news outlet basically said the Iranian delegation might not be going to Islamabad. And so, and as your reporter said, we have a ceasefire clock that is running down fast. And the level of tolerance of both parties for continuing to wage this war is different. I think the U.S. maybe has a 2-3 week window. After that, whatever happening in the oil market is going to affect and impact the U.S., whereas I think Iran thinks that they can sustain this war for 2-3 months. And Iran wants to consolidate whatever victories they have achieved in this war, including control over the Strait of Hormuz. And the U.S., especially the president, need to get a win before, quitting, before finalizing this. And particularly the win is in the nuclear field, both on the enrichment side as well on the highly enriched stockpile that Iran has.
How would you assess the prospects of another round of talks at this stage then? To your point about what Iranian media have indicated, that they are unlikely to come to the table as long as this blockade continues.
Look, there is an Iranian negotiation choreography, if we can put it this way, which has been their modus operandi throughout this conflict. You escalate on the ground, and then eventually you moderate at the table. And I think right now we are in this escalatory trajectory ahead of potential a negotiation track opening up. And both of them, I mean, the United States and Iran, are interested in these talks, are interested in these negotiations, but they need to engage in this kind of brinkmanship ahead of the negotiation, partly to increase their negotiation leverage, and second, to placate their domestic audiences. After all, there are hardliners in Iran who are not interested in going to this negotiation, who think they are winning, and they need to just continue with this fight or continue with this blockade in order to, consolidate these victories.
And as you said, does winning for Iran just constitute surviving for another 2 to 3 months, as you said earlier? Because that's a really long timeline when you think about all of the warnings that we're getting about global oil and byproduct supplies at the moment, with $4 a gallon in the U.S. when it comes to gas prices headed to the midterms. Can the United States or the Trump administration survive this?
That's where Iran thinks that they are winning. I think, although both sides are claiming that they are at this stage winning, but definitely the Iranian think that they can win. Their tolerance, their resilience for a 2-3 month continuation of this war is much higher than the tolerance and the resilience of the Trump administration. You already have an administration that's facing the majority of the U.S. public that is against this war and does not see the president as doing a good job managing this war. And so, and that's what the Iranians are trying to play on, is to use this kind of leverage over the time window that the Trump administration can afford in order to basically, increase or strengthen their negotiation hands.
So how long will the other countries, the rest of the world, stand still? Because right now, the calculation is that the U.S. energy landscape, that the U.S. economy is pretty resilient, which is why we saw record highs just last week when it comes to the markets. That's not the case for the rest of the world. Asia is already contending with fuel shortages. And you're even hearing from the UAE on media reports that they want the currency swap line with the United States. So how much longer can the rest of the world be okay standing still and waiting for the U.S., Israel, and Iran to work it out?
I think not long. I think their time window is not definitely 2 to 3 months. I think if the time window for the U.S. is 2 to 3 weeks, as far as the oil markets are concerned, or I think it's the same kind of time window, especially for markets especially for countries where we're already seeing their oil reserves dwindling or even disappearing fast. And so, and then you are seeing, we have heard what the UAE has requested recently. I think you are going to see other Gulf countries making the same request of the U.S., especially that they think that they tried or they advised the U.S. not to go into this war, and yet the American administration decided to go into this war, and they feel that the Americans have pushed them into this basically mess that they are right now living through. And so we are heading toward a reckoning soon. And I'm not talking about months, especially for the U.S. and for their allies in the region, as well as in throughout the world. And we are talking about weeks and not months.
And the thing is that it also makes you think, who wins out of all of this, right? Because the UAE apparently is now saying that they could turn towards using more of the yuan, for example. So will there be winners out of this that does not entail the U.S. just because this conflict continues to get dragged?
Look, I mean, China is definitely, sitting on the sidelines, watching carefully what's taking place. And I'm pretty sure the kind of deleveraging of the U.S. position in the GCC is music to Chinese leaders' ears. However, we have not seen yet China is interested or willing to abandon its Middle East security strategy, or how it has approached the Middle East. And also, we have to be frank. I mean, countries in the Gulf, although they are talking now about maybe not needing U.S. bases in the future, or maybe having to develop a different alternative to the U.S. security umbrella, they really don't have an alternative, and there is no alternative right now. And so they are stuck in terms of their dependence on the US, but at the same time realizing that the cost of this dependence is increasing incrementally.
Randa, even as we talk about the here and now and how countries are weighing out the cost of the conflict, and perhaps this realliance is underway, talk to us about what is the one big change you see in terms of the power structures in the Middle East once we get out of this on the other side?
I think the one big change is going to be the Iran-GCC relationship going forward. And I don't think the Iranian leaders realize now how costly this is going to be to them long term, especially in terms of the economics. I think the countries of the region have invested in the past in rapprochement and de-escalation with Iran, and they were really shocked. You know, they are now facing some kind of a strategic shock over Iranian behavior and targeting of their civilian infrastructure throughout this conflict. And so I think going forward, I think this relationship, which until recently has been de-escalatory, more rapprochement, détente even, I think we cannot restore the status quo ante in this relationship. And the countries of the Gulf are going to be looking at a different kind of basically approach to Iran. And partly is going to be doubling down on the US, because the trust or their their belief that this relationship could be restored with the relationship with Iran, I think right now is quite minimal.
Right. Randa Slim, really great to get your insights. Thank you so much for that. Senior Fellow at Johns Hopkins University School of Advanced International Studies. This is Bloomberg.
Take a look at how oil prices are faring amid this recent escalation in the conflict, as it also is dragging the US dollar up along with it. US stock futures are sitting lower, and of course this was after a week where we saw a really strong rally. Traders gearing up for a bumpy open to the week after this latest escalation in the conflict. Let's get more with Garfield Reynolds, who leads our MLive Asia coverage. Garf, we saw perhaps the importance for traders to have some sort of upside protection last week. I mean, given these latest developments over the weekend, how are investors going to price this?
Well, Avril, I think investors are very much going to be looking nervously at today's open, with oil jumping 7 to 8% or so, oil futures, that is, and looking to see, does that increase fade away, which was what happened. You have to remember the beginning of last week, we had a huge jump in oil prices when things looked pretty dire coming out of last weekend. And then by the end of the New York day, most of that had been erased because President Trump was sounding more conciliatory. The fact that the talks over the weekend had not led to a deal suddenly didn't seem so much of a concern, and equity traders in particular just went back to taking a look at what their base case was for where equities would go, assuming, fairly heroic assumption, assuming that peace will be reached and that the Strait of Hormuz will reopen, and therefore, given what had gone on so far with a range of sectors, especially tech, having dropped in price and no serious change in what investors' expectations are when it comes to earnings, that meant equities looked cheap, so pile into equities.
Treasuries never fully bought into the peace trade, though, did they? Because, I mean, yes, they did rally on the Friday session, but still 2-year yields are higher. Inflation concerns seem to be bigger at this point. How important will Tuesday's Senate confirmation hearing of Kevin Warsh be for the future of where yields go from here?
Well, in the short term, it might not have much impact if we get some large moves either up or down in that oil price. Over the longer term, it is going to matter, because for bond investors, the concern is what is this war doing to inflation and especially to inflation expectations? And then on top of that, how is the Fed going to interpret that? If we didn't have a situation where Jerome Powell's chairmanship of the Fed was due to expire soon, then we might well have already a slightly gloomier outlook for treasuries, because in the current environment, the Powell Fed is very clearly on hold until there's clarity on, pretty much probably until we get an actual resolution one way or the other on the Strait of Hormuz, on the overall outlook for the oil industry and for the oil price. So, but with, that's not the case. We have Walsh heading for his confirmation hearings. Traders are going to be very interested to hear what he's saying about the likely dynamics for rates. And I think the general expectation is that he will be quite keen to be easing policy toward the end of the year.
With that in mind, and along with potentially how markets refocus back on AI, corporate resilience, to your point earlier, what are you expecting to see in Asia for today and indeed this week?
Well, today I think Asia is going to do it pretty tough, because there's not likely to be too much that's coming out, famous last words, that would indicate a shift back towards what we saw on Friday. So instead, we've got Asia, and remember, Asia is more immediately vulnerable to the closure of the Strait of Hormuz. And from Asia's point of view, a week has passed, and yet there's still no serious, if anything, the blockage has become more severe. So from Asia's point of view, we're going to see declines at the open. We saw the Asian markets a lot less buoyant on Friday, because remember, at the time that Asia went home on Friday, the situation was looking more like sort of what we've got now. We didn't have Iran at that stage announcing an opening. It's since closed, which actually makes the closure look more solid potentially. So I think Asian stocks are likely to sell off today. It's probably not going to be as deep a sell-off as we saw a week ago, because we do have that overall hope that the US and Iran, that they are negotiating through back channels, that they might lower the temperature a bit. So declines, but probably modest from Asia. Then we're looking for, in the US day, what goes on there? How does President Trump react to the situation on the ground?
Garth, thank you so much. Always good to have you. Garfield Reynolds, who leads Bloomberg's MLive Asia coverage. We have more ahead on the Asia trade. This is Bloomberg. Quick look at what we're seeing in currencies as well. Amid the return to some demand for havens, the Bloomberg Dollar Index is climbing a little. We are seeing the yen on the back foot, back at the 159 level now. And against this backdrop, of course, risk-related currencies such as the Aussie dollar are on the back foot in the early goings in Asia trade. We have more ahead on the program. This is Bloomberg. We're tracking the latest developments in this re-escalation of the conflict in Iran, and essentially the Hormuz traffic being effectively grinding to a halt yet again. We are seeing oil prices reacting, as are gas futures for Europe, and note there that volumes are pretty thin at this time. Let's bring in Stephen Stepczynski, who leads our Asia energy coverage. Stephen, help us make sense of this, because we're still below 100 on Brent, right? What do you think is prompting this perhaps more measured reaction in oil markets to the developments over the weekend?
Well, first, like you said, this is still early Asia trading. We don't have a lot of the traders in from Europe, in the US even, so maybe there's less liquidity. So that might be playing partly way into it. But also, when you do look at the situation on the ground, I think when you look at total worst case scenarios, there is still, I think, an expectation that there will be continued peace talks. I think when you look at a few weeks back when Trump was saying that he was going to attack the country and that he was going to essentially wipe them off the face of the earth, that was a much different situation. Now, yes, there are people boarding ships. Yes, there's the U.S. boarding ships. Yes, there's Hormuz still closed. That situation hasn't changed. But it doesn't seem like we've gotten to a position where there's an escalation of attacks between both sides. Now, that really depends on how Iran responds to this ship being taken. If they have a measured response, then perhaps we could see oil actually fall some more as there's an expectation there could be talks later this week. Of course, will they or won't they on Tuesday is a big question in terms of discussions. But if this does spiral into a situation where perhaps Iran takes a step back and says, okay, we're going to start attacking infrastructure across the Middle East, which they had done weeks before the ceasefire, then we could potentially be in a situation where oil does go above 100 and does start to rise towards levels like that.
Yeah, I mean, given that this is really a new energy reality, right? Something that we thought was once unthinkable, the fact that the Strait of Hormuz can be closed like this, does it make sense then that we have new ideas of new oil pipelines? The IEA's Fatih Birol, for example, talking about a corridor, Turkey, Iraq, and Europe.
Yeah, I mean, I think going forward, right, the cat is out of the bag, the toothpaste is out of the bottle. You can't put any of that back in, right? Whatever metaphor you want to choose. The fact of the matter is, forever, everyone's going to remember that Iran shut the Strait of Hormuz and that there was this widespread conflict that damaged facilities. It turned off the world's largest liquefied natural gas export facility in Qatar. It required some countries to reduce output. This is a major event, and it's going to require major rethink for the region and how they get the oil out. Obviously, Saudi Arabia, their bet on the East-West pipeline, which kind of pushed their oil away from the Persian Gulf towards the Red Sea so it can go through the Bab el-Mandeb Strait to customers in Asia. That has turned out to be a big win for them. Are these other producers like Iraq, will they also be looking at ways to getting the oil out of that region? And what the IEA does say may make sense, right? There is a way to get it out. There have been these discussions. It has been challenging to kind of figure it out on an economic and cost point of view. But now with the situation with oil closer to $100, with there's so much instability, Birol, who leads the IEA, says that perhaps there is a way forward. Now, I also want to note that there are going to be a lot of discussions about alternative routes. But these are all long-term investments. This is not something that fixes a situation this year, maybe not even next year. Pipelines take a long time to build. You need investors. But maybe in the late 2020s into the 2030s, the amount of oil that's coming out of the Persian Gulf via the Strait of Hormuz could look quite different.
What about LNG? We've been seeing a rethink amid a conflict, right?
Yeah.
How do you see things changing once we're out on the other side?
Right. So LNG, you've got the largest supplier, Qatar, shut production. Also, their supplies are trapped within the Strait of Hormuz. 5 ships. It looked like they were heading towards Hormuz from inside the Persian Gulf to get out to Asian customers. They ultimately did a U-turn and stayed in there. So clearly, the situation is on the top of mind of Asian customers and European customers as to what does the future of LNG look like. Qatar had this rock-solid reputation as the most reliable supplier. And, of course, of no fault of their own, they've had to declare force majeure because of the attacks on their facility. Will that mean that there will have to be premiums put into place, or rather discounts put into place for future Qatari supply? Will that mean that maybe LNG buyers look to other markets? Canada, for example, has started exporting LNG from their west coast to Asia. Does that become more attractive? There are really no straits or bottlenecks from the Pacific to Asian customers. And then Russia. Russia has sanctioned LNG on the water. Does that look more attractive as well to customers? Will they ask for the U.S. for waivers like they receive for Russian oil? Will that be an option going forward? So the calculus of the future of LNG, where Qatar was doing this massive expansion, they were the world's second largest LNG exporter. Will that continue? Will they still have that reputation of a rock-solid supplier despite this tension in the Middle East? That is something that buyers will have to look at going forward.
And Stephen, before we let you go, let's talk a little bit about jet fuel, because here in Japan, we're headed towards the Golden Week holidays, and of course, it's summer holiday season in the U.S. as well coming up. Will we still be able to fly? Will there be enough supplies through the summer if this continues?
You know, I think every region looks a little bit different. It looks like Europe is one of the hardest hit. While there is supply available, there has been warnings from Europe that perhaps in the near future it could get a lot tighter and you could see prices rise. You've already seen a quite significant increase in jet fuel prices. I think that's very interesting to make the distinction between Brent oil, which we're seeing on the screen, and jet fuel, the products. While Brent has risen over the last this day and this morning, you are down from the highs seen in March. Jet fuel, on the other hand, has continuously risen and increased in prices in different regions because the supply there is so tight. Now, will we be able to fly out of Japan or other places for Golden Week? Certainly you will, but the cost of flying will increase. Also, there will be fewer flights potentially, especially in Europe. They've cut down the number of flights that they've had. There's also, of course, the Middle East, which with the tension continuing, a lot of flights there have been canceled. And if you're flying from Asia into Europe, you're going to have to go over airspace that is not part of this conflict, and that's making routes longer. That's causing a rethink as well as to schedules, which is resulting in delays and cancellations.
Stephen Sapchinsky, who leads our Asia energy coverage there with the latest on everything to do with the energy markets. And these are some of the other headlines that we're also following, because Australia's energy minister says the country's fuel reserves rose in the past week and more is on the way. Chris Bowen says that Australia now has 46 days of petrol on hand, 8 more than last week. He says an additional 61 fuel-laden ships are on their way. The increase in reserves comes after a fire at one of the country's 2 refineries raised concerns about tightening supplies. Australia also signing a deal for the first 3 of 11 advanced warships it plans to buy from Japan. Defense Minister Richard Marles and his Japanese counterpart Shinjiro Koizumi signed the agreement in Melbourne over the weekend. The upgraded Mogami-class frigates will be built in Japan at a cost of almost $11 billion, with the first delivery expected in 2029.
And the signing of the Mogami Memorandum, which we have just done now, will deepen defence industry cooperation between our two nations, specifically in the development of this critical capability for the Royal Australian Navy and also for Japan.
China's military is pushing further into the Western Pacific, deploying a naval task group for combat drills beyond the so-called First Island chain. That's a string of U.S. Pacific allies, including Japan, Taiwan, and the Philippines. China says the exercise is not aimed at any specific country. Beijing last week criticized the presence in the Taiwan Strait of a Japanese self-defense forces ship, calling it provocative. Take a look at how Asian markets are setting up. The open could be a little bit shakier, especially after the huge relief rally that we saw last week. On the Friday session, we saw the S&P 500 notching another record high. But of course, over the weekend, all of those mixed messages coming on the war in Iran continue to really hit investor sentiment. So we're seeing a little bit more risk off in the Asian session. You can see U.S. futures under a little bit of pressure, U.S. dollar rising a little bit, although Nikkei and Sydney futures at the moment pointing to a little bit of upside. But you can see crude prices right there just jumping almost 8%. So that's going to be felt across different sectors. But returning to the whole defense and military build-up narrative, we have seen this really a ramp-up of Asian defense stocks, attracting renewed investor interest given this arms buildup sparked by the Iran war. Let's discuss all of this with Asia equities reporter Sang-Mi Cha, who joins us in Hong Kong. And Sang-Mi, I mean, we've had this conversation around defense stocks for a while now, not necessarily only because of the Iran war, which is in its 7th week, but also because we had the Ukraine war, because we had more focus on NATO and just everybody trying to increase their defense budgets. Could this be a more long-term trade?
That's right, Shery. What's really behind the recent rally in these Asian defense stocks is because it's really not the tactical war trade because of the tensions in Iran. Rather, investors are telling us that this is a multi-year, a longer-term expansion of this theme, just highlighted by this Middle East situation, the indispensability of defense. And the reality is that the GDP, for 5% of GDP, in NATO, NATO members are expected to hit that. The defense spending is to hit 5% of that GDP target by 2035. And the European outlays have already been increasing 10% annually since 2021 because of the Ukraine conflict. So all of these governments are actually switching from just a very generic protection defense to a very active deterrence. And that is creating this huge demand gap that we're seeing. And of course, when we see that if there is this rise in budgets in Europe, that we would think that the Western giants are going to benefit. But the performances are showing that it is really not the case. All of these countries are actually turning to Asia to fill in that void. And, the investors are telling us that even if there's ceasefire tomorrow, and even if there is that, end of the war immediately, it doesn't mean that the Middle Eastern countries will just scale back their plans to add defense budgets.
Sang-mi, how is smart money adjusting to all this? Where is it moving to capture the growth beyond the major defense players in the region?
When we look at the global defense and aerospace gauge, we were able to see that the top five, among the top five performers of defense stocks, the three were located in Asia. These are LIG Defense, Hanwha Systems, the two Korean companies, but Astroscale is located in Japan. And so you can see that investors are not just looking at hardware tech here in terms of defense, but also some of the component makers that are deeply integrated in that supply chain. But when you look at India as well, it has been a laggard since mid-2025, but its defense index has rallied about 14% this year. And it's all because there is a structural change within the country that the government is pushing for local procurement. But even in the mature markets like Singapore, we have companies like ST Engineering that does aircraft maintenance. So all of these are pointing back to these Asian countries. And that's because there is that Asian advantage, the cost effectiveness, but also they produce NATO standard kits. And the timeline, the delivery timeline is just unmatchable by the Western companies. So Asia is slowly from that buyer of defense systems for ages, now is shifting back to its supplier mode. And that's what we're seeing in the defense stocks.
Interesting shifts. Sang-mi, thank you so much. Bloomberg Asia Equities reporter Sang-mi Cha in Hong Kong for us. More ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up for the market opens in 15 minutes. You can see right there that we're seeing a little bit of upside when it comes to Nikkei futures after stocks fell on the Friday session. We had a bit more optimism from Wall Street last week, given the expectations that the Iran war and a ceasefire might be on solid grounds, but we saw that turn over the weekend, rhetoric just hardening, and not to mention, of course, the seizing of an Iranian chip. You can see weakening of the Japanese yen towards that 160 level against the US dollars. We see a little bit more strength in the greenback right now, a little bit of defensive posture going into the trading session today. And as the uncertainty around the war in Iran ramps up once more, Goldman Sachs also downgrading their forecast for Japan. Joining us now is Tomohiro Ota, senior Japan economist at Goldman Sachs. Always good to see you. So are we talking about where are we going to see the spillover from the impact of the Iran war in the Japanese economy first?
Yeah, basically the main kind of channel must be that the Middle East turmoil and then which raise our inflation in Japan. and which lowered the real wage in Japan, and then that lowered the consumption growth. So that's the main reason why that we downgraded our focus.
Which is quite the difference from where we came last year when we thought real wages were finally starting to pick up.
Indeed.
So how much of an impact are we talking about?
Yeah, so basically we only revised down our consumption focus marginally by mainly two reasons. One, the inflation would not accelerate massively because of the comprehensive price control measures by Japanese government. So that's the fuel price is still contained in Japan, and that helps. And the second, another important thing is Japanese silver elderly household works as a shock absorber against a negative shock. And that's another reason why we didn't downgrade consumption much.
Elderly households are a large part of Japan's economy?
Yeah, actually in Japan, more than 50% of household is actually above 60 years old or above. And actually their consumption behavior is really different from the younger generation because basically in almost all younger generation, when the real income goes up, they increase their consumption and vice versa. But for elderly household, even if their real income goes up, they never change their consumption. Even if the real income goes down, still they maintain the same consumption. Maybe partly because their consumption pattern is quite conservative, and basically they have already retired, so they do not get the wage. So they don't care about the real wage growth anymore, and they have saving. So even if they don't have enough income from the pension, public pension, for example, they just withdraw money from that.
That is so interesting that Japan has a stable buffer of elderly consumers. You mentioned how the government could really help out in sort of absorbing some of the shock from higher energy prices, inflation. But for how long, especially if we're talking about supply chain disruptions, not only here in Japan, but all across Asia in the region?
Yeah. So this is basically that Japan has continued this price control measure in the last 4 years. So basically they have the big, long history. So it's not very easy for Japanese government to stop the price control measures sometime very soon. And so far, they didn't show any of such kind of signal. But if the situation gets worse, and then the inflation rate or the fuel price shot up much, much higher, and then the fiscal burden someday contains those policies. But we don't really see this in the timely fashion.
Tomohiro, Avril in Singapore here. I just wanted to ask you as well, perhaps, yes, there is a bit of a buffer, but how do you think authorities are viewing the currency weakness? Because there seems to be less of an appetite to cap any of that at this stage. Is that your read of the situation? How do you think they're assessing the picture overall?
Yeah, so basically that, yes, we know the dollar-yen is very at a weak level. But basically, it has been stable somewhere around the 150 to 160 rand in the last couple of years. So in that sense, actually, it is not a happy situation in terms of level. But basically, it no longer generates massive inflation in Japan. That's one of the reasons why that Prime Minister Takaichi was a bit kind of relaxed, has maintained a relaxed tone against the currency level at this level.
And what are you expecting out of the BOJ later in the month?
Yeah, basically we have been focusing from the more than several months that the next rate hike will be July. That's our base case scenario. So because two reasons. Anyway, monetary policy will affect the real economy in 9 to 12 months lag. So if the kind of say what is happening is a transitory inflation, BOJ better to wait. And now, we can't even see what is going to happen next week. No, not a year ahead. So in such kind of the situation with a mounting uncertainty, the BOJ has a very good reason to postpone their policy decision.
I think we have to be very careful with the infamous transitory line when it comes to inflation. But let me ask you, so if they don't move, say, in July, and then they postpone it, then obviously we could expect more weakness for the yen. But why is it that you say that it has less of an impact on inflation now in Japan?
Yeah, so basically, it is still for the fuel price. Basically, we are roughly immune from any of those fuel price surge. But actually, the weak yen can affect the various different kind of goods prices. So because basically we import so many things, so that those prices have no kind of price control measures. So if the dollar yen just depreciate massively, for example, and then that affects the inflation even bigger than what is happening. And then if those see, then the BOJ might worry is that the second round effect, as we have seen in Europe in 2022. In those cases, BOJ might accelerate the rate hike timing. That's why we didn't think that the possibility of June is zero. So if we see the sign of the second round effect, BOJ will do the rate hike earlier.
Just super quickly, is it more of a concern if you have higher yields and then you have all of these concerns around paying for all of the debt?
At this moment, yeah, we do not worry about that because, yes, the interest rate is high, but the Japanese government paid interest rate is still 0.8% because we had the Japanese government had a huge backlog of the 10, 20 years bond, which they issued at the 0% interest rate.
Tomohiro Ota, always good to get your insights. Senior Japan economist at Goldman Sachs joining me here in the Tokyo studio. And of course, you can catch Japan Ahead every Monday, 8:40 a.m. This is Bloomberg.
The latest from the corporate front, Bloomberg's learned that the world's top energy trader Vitol Group has told banks it made first quarter profit of around $2 billion. Vitol has been trying to reassure banks following a Bloomberg report that it was reorganizing its derivatives team, which suffered losses from early war-related price swings. Sources say the figure could still change as the company finalizes its accounts for the period. Google is reportedly in talks with Marvell Technology to develop 2 new custom AI chips. According to the information, one of them is a memory processing unit, while the other would be specifically built for running AI models. The report says discussions are focused on chips designed exclusively for Google. Markets open in Sydney, Seoul, and Tokyo next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. A little bit of a fragile setup across Asia this morning. Of course, we're still digesting those mixed messages coming on the course of the war in Iran, Avril. And of course, we're seeing a little bit more upside on the U.S. dollar defensive posturing, especially after that relief rally that we already saw last week.
Yeah, on top of potentially geopolitics as a driver for markets, this week we also have a catalyst in the form of the Senate confirmation hearing, of course, for Kevin Walsh. Might that also be a driver for bond traders to some extent, Shery?
Yeah, which was really interesting because treasuries didn't necessarily buy into the relief rally, right? 2-year yield still higher since the war began 7 weeks ago. We'll see how all of that translates into the Asian session as well as we're watching JGBs and, of course, policy direction in this part of the world. We had heard from Bank of Japan Governor Ueda not really giving clear indications of where the BOJ rate trajectory is going, especially later this month when we do have that April 28th rate decision. So that led to pressure on the Japanese yen, which continues into the early Asia session with the yen getting closer to that 160 level against the U.S. dollar. The Nikkei at the moment, slight gains early in the session at 0.4%. We had seen, of course, that loss in the Friday session last week. So we'll continue to watch some of those more sensitive sectors to the war in Iran, especially defensive, not to mention energy-related stocks. Also, keep an eye on the AI trade, of course. That's always the issue across Asian markets. As we are also seeing the Korean market coming online, we had seen a little bit of pressure in the previous session as well for the first time in 4 sessions. And the Korean won has been pretty range-bound because it's really all to do with the Iran war headlines and, of course, where global risk sentiment goes from here. And you can see a little bit of divergence with the Kospi gaining ground early in the session. And you can see the Korean won still weakening against the U.S. dollar, headed back towards that 1,500 level, Avril.
Shery, it's interesting how Asia indices are still managing to clock slight gains given the developments over the weekend on the Iran conflict, this escalation, and effectively the traffic in the Strait back to zero pretty much yet again. We are seeing oil prices reacting though, and you're surging roughly to the 97 handle now on Brent crude futures. That is dragging up along with it the US yields in a week where we are, of course, watching out for some of these developments out of the US as well. ASX, Australia stocks, we are pointing a bit lower, but overall you do get the sense that there is a pretty measured reaction to the developments over the weekend, Shery.
Yeah, and this week, of course, across Asia, we're also contending with central bank decisions, the likes of Indonesia and the Philippines expected to hold rates steady, and a lot to do with really controlling the weakness in some of their currencies like the rupiah, not to mention trying to contain inflationary pressures. Let's see what all of this means for the markets. Joining us now is Kerry Craig, global market strategist at JPMorgan Asset Management. Kerry, great to have you with us. I mean, last week it was all about that potential peace rally. What does this mean for the rest of the week? Because I feel like we're holding sort of a Groundhog Day pattern where we seem to be getting somewhere by the end of the week, and then the weekend happens and we're not really getting anything the following week. And this is 7 weeks into this conflict already.
That certainly is the case. It does seem like moving in circles to a certain degree, but I think the way the markets are digesting it is they continue to see this as at least pointing towards an off-ramp in the conflict in the Middle East. They're looking forward towards potentially some negotiations or a second round of negotiations happening, the potential at least flow of oil out of the Strait of Hormuz, even if it's not fully opened. And I think they're looking through what could be, the end or at least the beginning of the end of this conflict and focusing more on the micro fundamentals given we're entering the earnings season in the US and the strength of the earnings going on. So that's, again, why we're seeing the markets continue to move towards all-time highs in some areas and thinking about the prospects for a global economy that continues to rumble on and not really fearing some of those recessionary fears that may have been in the market when the oil price was much, much higher.
Inflationary concerns still seem to continue. Of course, oil jumping early in the Asian session, and we're seeing Treasury yields gaining as well. We've in fact seen the 2-year yield at higher levels than before the war. How consequential would the Senate hearing by Kevin Warsh on Tuesday be in sort of markets assessing where potentially the Fed could go from here?
Yeah, I mean, Kevin Warsh has been pretty adamant about having lower interest rates in the US. He's been very vocal on the use of the balance sheet and changing the way the Fed has used the balance sheet in the past. So I think those are two clear things that will come out of the Senate hearing, questions around his views on the balance sheet and also on interest rates. I think the conflict in the Middle East has obviously given a bit of a movement in terms of how he may interpret the short-term view on interest rates, the fact that the market is pricing out those rate cuts and thinking about potential for even a rate hike there may give him pause for thought to see that they still want to see lower interest rates overall. And I think there's a bit of a still disconnect between the confirmation hearing and him actually becoming the chair of the Federal Reserve in terms of what that means for the outlook. Certainly other members of the FOMC have been a little bit more or less dovish when it comes to that outlook, and certainly thinking about a more patient outlook for central banks and the Federal Reserve as they digest what the short-term inflationary consequences of this could be and also the implications for growth. Our view is that the Federal Reserve is likely to see inflation that will be relatively transitory and growth that will weaken over the course of this year, and they'll be much closer to their inflation goal by the end of this year, which would still allow them to ease policy rates.
Kerry, I think markets also in some ways being desensitized to these headlines coming in. What is your read on the extent in which AI investments, corporate resilience is going to be a driver for the next couple of weeks?
I think it's still going to be dominant when we think about some of the bottlenecks we're hearing in the market, the demand for semiconductors, the demand for memory, the fact that we're moving from that shift in terms of all that compute power that was needed to train these models and inference that was coming through to being more based on the use of that. And that can be a lot higher. And so it's creating this demand and supporting, memory makers throughout Asia, semiconductor production throughout Korea and Taiwan. And I think it's a key focus for markets and certainly still an area of the market that we like. And that also extends into thinking about some of the tech story coming from China. So those secular themes that are still there in the market do create attractive opportunities for investors, particularly given in the US case, at least, we've seen underperformance in some of those hyperscaler names and valuations come down a long way. So creating a perhaps more attractive entry opportunity. So I think there's still that bias towards thinking about quality in a portfolio. Some of those growth stocks do present that given their strength in their balance sheet. So there are still opportunities for having that risk on tilt, even with some of this sort of confusion or cloud over the macro backdrop at the moment.
What are we seeing in terms of the currency read-through, though? Because I think there are a bit of cross-currents for the Korean won, for example, that today is among the currencies on the back foot. I think we're losing by the most since early March 5th, thereabouts. Does that represent a sort of headwind for investors when they view Korean assets overall?
I think it's been a challenge when it comes to the currency outlook. You've seen a big movement from Korean investors in towards the US, which has been one of the key reasons the currency has not done what you think it should do given the rates outlook and where the economy is heading. However, I think that there is still ample opportunity within Korea and a lot of demand from foreign investors. Certainly when we look at developed world ex-US relative to emerging markets do seem more favourable in this context. And again, being part of that key AI supply chain should be something that we focus on when it comes to Korea. Currencies, obviously a contemplation for thinking about hedging or unhedged risk towards those markets. If we do think about that pressure that we've seen in the Korean won, obviously we want to think more about how much hedging exposure we want to take within that, and also the direction of the US dollar, which has been so key to this. So we do think about the prospects for that safe haven currency has been relatively tepid in this environment, but that flow through to demand for those strong AI names within the US, that hue of a US exceptionalism coming back to a certain degree could continue to support the US dollar in that environment and potentially weigh more on the Korean currency as well if we think about that cross rate.
Kerry, good to chat. We'll leave it there for today. Thank you so much for taking the time. Kerry Craig is Global Market Strategist at JPMorgan Asset Management. Let's take a look at some of the movers in Australia as well. Yes, we are seeing energy prices surging. Basically, Brent is just under the 97 handle, but given maybe how investors see the moves as quite measured in the energy prices, it seems like that may be dragging these energy-related stocks. I think they are among the sectors that are underperforming on the ASX 200 this morning, and this is coming at the time, of course, where companies such as Viva are in focus as it works to get its refinery fuel output back to normal. It sees this at 90% within weeks. And of course, this is following on from a recent fire and fuel output being cut. More ahead on the Asia trade. This is Bloomberg.
We're seeing Brent and U.S. crude jumping more than 7% early in the Asia session. Really not surprising given the escalation of the conflict in Iran with the Strait of Hormuz, especially with that Iranian ship being seized by the U.S. You can see U.S. futures now down 0.8% after reaching record highs last week. In fact, when it comes to the S&P 500, we're headed for the best monthly gain since 2020. We have had a lot of optimism about the Iran war, the course or an end to the war coming up soon, but we're seeing a little bit of a reversal of that risk-on sentiment. Still, when it comes to the MSCI Asia Pacific Index, energy stocks are the leading decliners today. This is 7th week into the conflict, so perhaps a little bit more resilience when it comes to these geopolitical headlines. Let's get the latest on the escalation of the conflict, though, with Bloomberg Politics editor Laura Davis. And Laura, because we're still trying to figure out where we are in these negotiations, it seems the mixed messaging continues, especially over the weekend. On Friday, President Trump was saying that he trusted the Iranians, and now he's again threatening military action.
Yes, this is, about the third time we found ourselves in this cycle of that, Trump announces that there's some sort of deal that's imminent. The Iranians contradict that to some level. And then Trump sort of escalates by saying he's going to take out civilian power plants or target other key sites within the country, bridges also as well. So this is kind of the cycle that we've seen play out. And we are at this very fragile moment because we are just about 2 days away from this 14-day ceasefire expiring. It's not clear if talks are going to take place between the U.S. and Iran. Islamabad is preparing to host these talks. The White House has said that J.D. Vance, as well as Steve Witkoff and Jared Kushner, are going to go to Pakistan for these negotiations. But Iranians have denied that they will take part in that. So we could find ourselves in just about a 48-hour period at a point where a ceasefire has expired. And tensions are at this all-time high. We have the U.S. seizing this Iranian ship. We have Iran also firing on at least one ship within the Strait of Hormuz as it tried to pass. So tensions are really at an all-time high. And, of course, the other key sign for optimism we had last week, which was a ceasefire between Lebanon and Israel, that also seems to be breaking down as well, with Israel continuing to launch attacks at Hezbollah, which operates inside Lebanon.
Laura, how committed is the U.S. at this stage to providing support for Gulf countries, not just in forms of defense, military, but also financial backstops? What do we know?
This is, a really, really good question. And there's a report out from the Wall Street Journal talking about the UAE seeking a currency swap line from the U.S. There were meetings last week between UAE officials and the Treasury Department and the Federal Reserve talking about some sort of, financial instrument there that could help the UAE in the event of a liquidity crisis. But as we hit, almost the 2-month mark of this war, you're starting to see Gulf allies not only worry about their own regional security. That was a concern, some weeks ago, but also sort of what their broader economic prospects look like as they've been unable to export much of their oil. They have been sort of in the direct line of fire of some of these attacks. Key energy sites have been destroyed, as well as no clear prospect on when this actually returns. So this is going to be a real test for the U.S. Trump has been quite dismissive of allies' wants and needs so far. We've heard him feuding with Spain and with the U.K. and other European allies. Gulf allies are really in a different position because they are truly on the front lines of this conflict. And, if Trump, denies some of these requests, you could really see the U.S. become even more isolated.
Laura, thank you so much. Bloomberg politics editor Laura Davison with the latest for us. And let's take a look at how commodities are faring. Of course, we've been seeing oil prices trending higher. Today, Brent sitting just around the 96 handle as the re-escalation of the conflict over the weekend with the U.S. Navy seizing an Iranian ship has led to traffic pretty much grinding to a halt yet again. For more, let's bring in Bloomberg oil and shipping reporter Wei Lun Soon. So, Wei Lun, are we back to the way things were a couple of weeks ago? How does this affect prospects for the full reopening of the strait?
That's right, Avril. So what we have seen over the past the weekend is a lot of chaos in the Strait of Hormuz, and traffic on Sunday appears to have come to a halt again. 0 ships went through. So this actually just comes after we saw maybe a tick up in traffic about a week ago. Why are we seeing this now? Because Iran and the U.S. appear to be amping up their control of the strait. There's a double blockade going on. Some ships tried to go through on Friday after Trump said that it was open, but the Iranians wanted to gain control of Hormuz again, and that's why we hear gunshots being fired at ships. One of them a crude tanker, and then this morning we saw the U.S. seizing an Iranian ship. So tensions are going up very high. Brent and WTI is reflecting this increase in tension, but still not as high as we thought it would be. That's because it appears that the ceasefire is still in place. It just brings us back to the worst case scenario that we have seen at the beginning of the war.
Yeah, no wonder we're hearing from the IEA proposing the build out of a new oil pipeline. But this would be more long term, especially if we're talking about Iraq, Turkey, and Europe.
Exactly. This is not a near-term solution, but it does lay out the plans for future potential conflicts or even choke points being held. So countries like Turkey, like Iraq, and we have seen Saudi Arabia also rediverting some of those Persian Gulf exports down to the Red Sea. So the Persian Gulf exporters are trying to make backup plans, but these definitely will not in the near term trying to alleviate those concerns.
Wei Lun, you've been tracking these vessels so closely, and I think among those that tried to breach the blockade, or at least to make it out of the strait, was an Indian vessel. I mean, provide some color to that. What do we know about what transpired there?
Right. So over the weekend, we were furiously trying to find out what was happening in the street. We have heard and seen messages being exchanged between the captain on the ship and also some of the ship owners that were managing these ships. There was a lot of confusion. Some of them thought, including the Indian tanker, thought that they had the all clear. As to clearance from who, we don't know for sure yet. But on the second try, this Indian tanker, super tanker, laden with crude, was trying to head out of Hormuz when it got approached by one or two small boats, presumably Iranian, and they were fired on. It was a small gunfire, but to someone on the ship steering a huge crude super tanker, that's a very frightening prospect, and that's why they turned back again.
Talk to us also about what we are seeing in the shifts amid the oil flows, amid all of this. I mean, economies in the region, especially in Asia, they are waiting out to see how long this will last. But what do we know about maybe stockpiles? How much buffer do they really have?
The numbers vary because stockpiling is a really, to some countries, it's a sensitive topic. But we know that Japan has already made promises to release some of its reserves 2 times now. I believe in May. Some of the other countries, China is controlling exports of oil products. Some of the India, which is a big importer of crude too, has turned to Iranian and even Russian crude. So Asian countries are really turning to different ways of securing crude beyond the Middle East, and they're paying a high price for it. Some of them also even turning to US crude. But bear in mind that these crude grades are not a perfect replacement for Middle Eastern crude because Asian refineries were built around processing Middle Eastern crude. So we should expect to see more release of stockpiles perhaps in the near future.
Wei Lun Soon, oil and shipping reporter there with the latest on the energy markets today. Now, Bloomberg Opinion columnist David Ficklin says South Korea's energy transition is stalling with heavy fossil fuel dependence, entrenched interests, and regulatory barriers undermining its clean power ambitions. He joins us now in Sydney. David, I mean, your column today, and all of our viewers should be reading this, you're actually likening South Korea's energy policy to K-pop Demon Hunter's movie, depicting a boy band acting as a cover in order to feed humanity to a monster. What is this about?
Well, look, I mean, I think it's actually a sort of reasonable analogy because there's been a lot of good publicity in the recent month or so. President Lee has been one of the most prominent people to link the energy transition to energy security. Of course, South Korea is very dependent on Qatari gas to power its industry, including, of course, the biggest memory chip industry in the world. And also there have been a lot of high-profile initiatives like putting solar panels on car parks, mandating those, that have got a lot of good attention. But I think the underlying fact that we need to recognise is that South Korea is one of the most fossil fuel-dependent major economies in the world. It uses more coal per capita than any country apart from, I think, China, here Australia, and Kazakhstan. And a lot of those transition initiatives, those renewable initiatives, are really stalling at the moment.
David, unlike in the movie, South Korea can't quite sing or K-pop its way out of this. So what more do they need to do?
I think the institutional barriers are very, very high, and I think that's not appreciated as much outside South Korea. It typically takes about 10 years to get a wind power plant approved. You used to need to go through, I think, 22 sets of regulations and 8 different ministries to get it done. KEPCO, which is the monopoly generator and distributor and transmission company, it doesn't like any of these projects, and it stands in the way of them. Just a rule announced recently basically banned any new connections of generators until 2032 in a large swathe of the country, which is obviously a problem if you want to meet President Lee's targets of getting 30% compared to 10% from renewables by 2035. So there's a lot of stuff that needs to be unpicked, and you know, I think President Lee's got a lot of positive attention for some of the stuff he's been saying, but to actually turn it into reality is going to be a lot harder.
But David, yeah, you said it, right? I mean, this is a long-term situation that they need to invest now in order to reap the fruits later. And the fact is that the president only has 5-year non-consecutive terms anyway. So how big of a political constraint is this in trying to set up for the long term? And will the Iran war, could it be a catalyst for actual change?
I mean, I think this has really highlighted the dangers as a national security thing for South Korea. Of course, we've seen, you know, for one thing, you know, a large slice of their energy is dependent on this Qatari gas, and that's now cut off. But also, it's shown the risks of asymmetric warfare. North Korea has a very large minor warfare fleet, which is something that South Korea is constantly concerned about. And this has really shown how effective that could be in really cutting off the country from these energy imports that it constantly depends on. So I think the first thing to do is really to take on KEPCO. KEPCO is government-owned. It has very high debt levels. It's probably going to lose money on electricity this year because whenever gas prices go up, it loses money. But it's standing in the way of the government's own energy policy. So, you know, first, I think President Lee needs to take that on. And then the next stage, I think there is a lot of community opposition amongst things like fishing groups, which are causing a lot of the offshore wind that's been planned for South Korea to sort of fall off at the moment. And again, this is a sort of institutional thing that needs to be taken on if they take this seriously as an energy security issue. And I think clearly from the rhetoric that we're hearing from President Lee, it is a national security issue. But if they really care about that, they need to actually enact the policies to treat it that way.
Bloomberg Opinion columnist David Ficklin there joining us from Sydney. We do have more ahead on the Asia trade. This is Bloomberg. Take a look at how South Korean stocks are trading early in the Asia session. We are seeing small gains for the Kospi. Goldman Sachs actually increasing their target for the Kospi to 8,000 from 7,000, citing earnings upgrades for strong AI-related chip demand and favorable valuations. To that point, SK Hynix now beginning production of the 192GB SOCAMM 2. This is a next-generation memory module and is designed for NVIDIA's Vera Rubin platform. But do watch out for those automakers, perhaps a little bit of pressure. The Trump administration, according to sources, considering changes to North American trade rules that could raise tariff costs on U.S. auto imports. This is Bloomberg.
Take a look at the Treasuries curve. We are seeing 2s, 10s, 30s, the yields inching higher amid concerns about perhaps higher inflation, slower growth. Although it's worth noting that for Treasuries, I think they never really bought into the narrative about peace anyway. You are, of course, watching out for Asia this week in terms of a couple of central bank decisions in the Philippines, Indonesia. They're expected to keep things unchanged. But of course, the growth inflation dynamic is one for Asia central banks to contend with as well. Deepali Bhargava is head of research and chief APEC economist at ING. Deepali, good to have you in the studio. So we are looking at perhaps some of the indications coming in early on in terms of the data. Maybe leave China out of this, but slower growth, inflation is showing up in some of these prints. To what extent are you expecting this week that we'll see, you know, these central banks will give us a signal that they can continue holding for the foreseeable future?
Yeah, I think it's a great question. And I think the central banks that are meeting this week are the EM central banks. So really the economies that have been hit hard by this oil crisis, right? And unfortunately, especially Indonesia and Philippines, did not have a very good starting point on growth. So like we know, Philippines is going through its own struggle on the corruption scandals, and we recently downgraded GDP growth pretty massively from 5.2 to 4.5%. Indonesia itself is going through its own challenges. So luckily, Indonesia doesn't get impacted as much from the higher oil prices, because if you look at how much of the actual oil price increase has been transmitted to Indonesia in terms of higher domestic gasoline prices, it's a bit limited, fairly limited, because being absorbed by fiscal subsidies. So I think the challenge for Indonesia is a bit weaker. But if you look at BSP on the other hand, I think they have a tough task. But to really answer your question, I think both central banks can't afford to not sound hawkish, because BI of course says their top mandate is FX stability. So while we expect them to keep rates unchanged, I think just because, like over the weekend, this whole peace talk turned around, I think it's essential for them to be able to talk hawkish for FX stability to prevail on IDR, and similarly for BSP.
You talk about these fiscal buffers. What's interesting to me, especially for EMs, is how, following on from COVID, they never really got a chance to build back these buffers up again. So how much of a risk is that going to be for perhaps the back half, the mid to longer term for these economies?
Yeah, so I think I would differentiate between the developed economies and the developing economies. So the developed economies like Japan, Korea, they have deeper buffers. And don't forget that when you look at this whole debt issue, which is like when we look at debt to GDP ratios, for Asia, yes, it's high for Japan, but in general, Asia is much better off compared to, for example, your Western world, which is Europe, etc. So I think, yes, Japan, Korea, they have better fiscal buffers in general for this year. But again, the EM is going to struggle. I think you're already seeing signs of a challenge of revenue growth pickup in Indonesia. And that's, I think, one of the main countries where we think fiscal buffers are fairly weak. Philippines is somewhere in the middle. India, I would say, is a bit better place. So it's a bit different for different economies.
Even as some of these economies already feel the second order effects in terms of these EMs, I think there is a sense of the way in which China has been a bit insulated from this growth, that surprise to the upside. What are you seeing in terms of the trajectory for the rest of the year and the extent in which we'll see monetary policy helping things along?
Yeah, I think really clearly an upside. The recent numbers, the first quarter numbers, surprised on the upside. And I think one key differentiator for China and developed Asia has been strong export growth and really the strong technology export growth. So it's benefited Taiwan, China, Korea, and the like. So there has been an upside. But don't forget that demand in the Western economies is going to slow down. So ultimately, we do expect this export slowdown to happen at some point this year, and especially if oil prices remain high, then the consumer in the Western world will be constrained. So exports will be constrained. So I think there will be a normal leveling off that will happen. We've also pushed out our rate cuts that we were expecting from China just because of this upside. And I think monetary policy easing matters for some economies, but perhaps not so much for China. I think they've got their own structural issues like the huge property decline to manage before you can actually call that domestic demand can recover and monetary policy can be supportive. Yeah. So I think for now, monetary policy in China can play a very small role indeed.
So you're not necessarily expecting any changes when it comes to the central bank, because we do have loan prime rates today. The expectation is for banks just to follow the PBOC and not do anything so far, right? When do you expect them to come in, and when would be the right time, given that we continuously talk about how China might be more resilient in this energy landscape, but at the same time, you also mentioned the fundamental issues with this economy?
Yeah, I think first of all, we don't have a lot of rate cuts coming in anyway from a PBOC because we just got like 10 basis point happening in about the third quarter. So clearly, the fiscal policy has a bigger role to play when you talk about China growth and how the domestic demand recovery needs to happen. So we need to see a lot more happen on the property side, on the infrastructure side for growth to recover. But monetary policy in that sense will really have to take a backseat.
A backseat for monetary policy here in Japan as well. The Bank of Japan rate decision, according to markets, doesn't seem to be changing this month.
Yeah, I think two economies where we actually see central banks hiking rates earlier than expected. One is RBA, and we know the story there. But even BOJ, we were of the view that Japan will be a go, but we've just moved the call to April. I think couple of indications from BOJ coming in very recently. So a couple of data points we think indicate that BOJ is trying to tell you. One is the output gap. So the latest series, the latest numbers that they released on the output gap, it does look like the output gap has closed and Japan is growing at above the potential. Two, the latest CPI readings that they have released, which is like CPI inflation excluding the very administrative related items. So if you put the subsidies aside, Japan inflation drop has not been all that much, as has been indicated by the headline series. So hence, we think rate hikes are actually coming in faster than expected in Japan, and we have a call for a BOJ hike in April.
Ooh, that's interesting, because I think some on the street still expect it to be July. Deepali, thanks for coming in. We'll leave it there for today. Great to chat. Deepali Bhargava is head of APAC research at ING. Now on to some other top global headlines we're following. Australia's energy minister says the country's fuel reserves rose in the past week and more is on the way. Chris Bowen says Australia now has 46 days of petrol on hand, 8 more than last week. He says an additional 61 fuel-laden ships are on their way. The increase in reserves comes after a fire at one of the country's 2 refineries raised concerns about tightening supplies. Australia has signed a deal for the first 3 of 11 advanced warships it plans to buy from Japan. Defense Minister Richard Marles and his Japanese counterpart Shinjiro Koizumi signed the agreement in Melbourne over the weekend. The upgraded Mogami-class frigates will be built in Japan at a cost of almost $11 billion, with the first delivery expected in 2029.
And the signing of the Mogami Memorandum, which we have just done now, will deepen defence industry cooperation between our 2 nations, specifically in the development of this critical capability for the Royal Australian Navy and also for Japan.
China's military is pushing further into the Western Pacific, deploying a naval task group for combat drills beyond the so-called First Island chain. That's a string of U.S. Pacific allies, including Japan, Taiwan, and the Philippines. China says the exercise is not aimed at any specific country. Beijing last week criticized the presence in the Taiwan Strait of a Japanese self-defense forces ship, calling it provocative. More ahead on the Asia trade. This is Bloomberg.
Keep an eye on software-related stocks across the Asia session. Of course, we had seen that disruption fear leading to a lot of volatility in this sector. But last week, really that huge rally that we saw in some of those software names taking tech software sector ETF IGV, for example, in the Wall Street session to new highs, 5 sessions of gains. And we're following, of course, Japanese equities related to that sector as well. And you can see that short squeeze that we saw also last week, given, of course, his focus back on this sector and potential more optimism after those disruption fears led to that massive sell-off just a few weeks back. But one of those stocks in Japan that's massively exposed to artificial intelligence overall is SoftBank. Bloomberg Opinion columnist Shery says the SoftBank's massive bet on OpenAI risks deepening its liquidity strain. Shery joins us now, and Shery, of course, SoftBank has made this massive bet, $30 billion investment in OpenAI. But the question has always been, where will they get the money from? What are you seeing in the numbers?
Absolutely. SoftBank is a 160 billion US dollar company, and it runs the world's biggest venture capital funds. But the problem with SoftBank is that it doesn't have very much cash, and it doesn't have any, not very much recurring revenue either. So to invest, to follow up on another 30 billion US dollars, SoftBank has to take a bridge loan of 40 billion US dollars. But that bridge loan is due within a year, and now credit investors are asking how SoftBank is going to come up with the money. Last year, for the first 30 billion, SoftBank did a lot of asset sales. It sold its entire stake in NVIDIA. It sold a lot of its shares in T-Mobile. And this year, people are saying that unless OpenAI manages to go public within the next year or so, SoftBank could be in a lot more trouble. In fact, last week, SoftBank raised 3.6 billion US dollars from overseas bond sales, and it was paying the highest interest rate on record.
Yeah, and Shery, not to mention how SoftBank's bet on OpenAI already so far has been going quite well. I think it recorded, $20 billion worth of unrealized capital gains. So why is Masayoshi Son taking this move? Isn't it a bit risky, all things considered?
Absolutely. I mean, one possible explanation is just personality. Masa-san is a risk-taking guy. He's the kind of a go big or go home kind of guy, right? Like in the past, he has done very well on big bets on Alibaba Holdings and on ARM Holdings, and very badly on, say, WeWork. But so that could just be his investment strategy, just go all in on one big bet. Another possible explanation is that, like OpenAI's latest funding round was valuing the company at 850 billion US dollars. And even the earlier backers of OpenAI, they were saying that valuation is too high. To get that kind of valuation, OpenAI needs some kind of a cornerstone anchor investor to say, yes, OpenAI is worth that much money. Now, Amazon and NVIDIA were also big investors, but they came with a lot of strings attached. In fact, the money that they get, OpenAI gets from Amazon and NVIDIA, they're going to be plowed back into these two tech companies for chips, right? So only SoftBank can come in and say, okay, OpenAI is worth 850 billion.
All right, really interesting. Shery, thank you so much. Great piece. Bloomberg Opinion columnist Shery Ren in Hong Kong for us. And some other top corporate stories we're tracking as well. Google reportedly in talks with Marvell Technology to develop 2 new custom AI chips. According to the information, one of them is a memory processing unit, while the other would be specifically built for running AI models. The report says discussions are focused on chips designed exclusively for Google. AI chipmaker and data center operator Cerebras Systems has filed publicly for a U.S. IPO around 6 months after withdrawing a previous attempt. Sources say it filed confidentially for a listing that could raise around $2 billion. The firm is part of a growing cohort seeking to challenge market leader NVIDIA. Shery?
Right, Avril, Blue Origin's New Glenn rocket has completed its 3rd flight, reusing a booster for the first time. But the mission failed to correctly place the satellite in its intended orbit. Blue Origin CEO Dave Limp told Bloomberg exclusively that he sees more New Glenn flights in 2026.
I think it'd be a really good year if we could do, 8 to 12 flights this year, up from 2 last year. That would be, that'd be a good cadence for us. I can see a path that we have plenty of hardware to do that. It really is what we learn from the flights. I would tell you that there's never been a time where launch is in such demand. And by the way, I think the demand's going up with all these direct-to-device announcements. Amazon made one, obviously. Other AST is doing direct-to-device. And these mega constellations, we have our own constellation we announced with TerraWave. That if I could fly a rocket every week right now, I would be sold out for the indefinite future. And so our job is to get out there, get as fast a cadence as we can, as quickly as possible. And the foundation of that, again, is just to build a world-class manufacturing business. And that's something I've done for a long time, and the team's done for a long time. And I think we're on the right path. We still have a ways to go, but I'm excited about the progress.
The world became familiar with Blue Origin through New Shepard, the smaller form factor launch system, and the first focus of that was kind of space tourism. Going to a pretty low altitude, relatively speaking, for a few minutes of weightlessness. And of course, I was in Van Horn, Texas, when Jeff Bezos himself went up. But you took the decision to halt that program, in large part to focus on Blue's participation in getting America back to the moon. And so, in the first instance, Dave, what has the result of that decision been? Have you been able to accelerate that other program, the Lunar program? How have you moved and reassigned resource and people to fulfill that ambition?
Yeah, we were able to fly 98 people above the Kármán line. I've never seen so many smiles on every astronaut that we were able to do that for. And I think if you had to make the decision to put New Shepard on pause, we put on pause for at least 2 years. With your heart, it would have been a very hard decision, because you saw it when you saw Jeff fly. Every customer is the happiest customer you've ever seen. But when you make that decision with your head, it was probably one of the simpler business decisions that I and Jeff have ever made, because I'm so passionate about getting the U.S. back to the moon, as is Jeff. It's I don't think the country wants another Sputnik moment. We have been saying at Blue for 20 plus years that the moon is this incredible gift given to us. It's 3 days away. It's got all the resources that we'll ever need right there, at least for the foreseeable millennium ahead of us, and we know how to get there.
Blue Origin CEO Dave Limp speaking exclusively with Bloomberg Tech co-anchor Ed Ludlow. We have more ahead on the Asia trade. This is Bloomberg.
Singapore is facing a tougher growth environment as increased protectionism and geopolitical rivalries threaten its trade and foreign investment flows. Bloomberg Intelligence now expects GDP expansion this year of 2.5% after an outsized bounce in 2025 of 5%. For more on BI's annual Singapore briefing, let's bring in senior analyst Sarah Jane Mahmood. Sarah, great to see you on the back of this research piece, right? To what extent has been the assessment that, globalization's retreat or a retreat from globalization is posing a challenge to Singapore's growth?
Well, Singapore really is the poster child of globalization. And as companies are seeking to take back their supply chains with fragmentation of the global order, the traditional role of Singapore as a bridge between East and West, it might become a little bit less comfortable. So our report looks at how Singapore is likely to fare over the next 5 years. Now, economic growth is likely to slow, but we predict that it's likely to hover around 2 to 3% a year through to 2030. And this is actually higher than most mature economies. Singapore is also likely to remain a magnet for multinational investment.
So global companies are still choosing Singapore. I mean, are we seeing a bit of that safe haven flows into the Lion City in some way? Why are regional companies still choosing Singapore as a hub?
Absolutely. I think multinationals will still look at Singapore. I think Singapore will still be a very competitive base for their regional headquarters, providing strong competition to other Asian cities like Hong Kong, or even cheaper cost bases like KL. And this is backed by stability, a strong regulatory framework, transparent governance, and also very strong intellectual property and contract enforcement, which does give companies looking to move over here a lot of certainty. There's also strong infrastructure infrastructure in Singapore, with developments underway at Changi Airport, at Tuas Port, and also the RTS with Malaysia, which is set to open later this year.
And that could benefit some of the lenders in Singapore as well. Talk to us about some of the, positioning as it becomes leader potentially in frontier economies, AI, for example. What are the plans there, and what sort of industries stand to gain the most?
I think Singapore is in a very strong position to build on its status as a regional hub for artificial intelligence. And just among the banks that I cover, DBS, OCBC, UOB, our sensitivity analysis does suggest that they could unlock up to 5 billion Singapore dollars collectively on full, so 100% integration of artificial intelligence technology through a mixture of revenue gains and cost savings. Wider than that, the government is fully supportive of accelerating artificial intelligence adoption across various sectors, and that is reflected in the fresh 1 billion injection into public-private artificial intelligence, which was announced earlier this year. And it's likely to attract more tech companies to set up in Singapore to complement bases already set up by Google, Amazon Web Services, Tata Consultancy, ByteDance, and a lot more. And essentially, all sectors are likely to benefit, but our report looks at the biggest benefit going to the advanced manufacturing sector, so semiconductors and biotech industries.
Sarah, just very quickly as well, amid the AI focus, we are also looking at Singapore's reinvigoration or the efforts to do that for the stock market. What is biting so far? What else needs to be done?
So the equity market is hovering around 1 trillion Singapore dollars, and we have seen relatively slow growth since 2010, I think on average around 2% a year. But this could change with efforts to revive the stock market led by the 6.5 billion allocation to locally based fund managers that could spark renewed interest, particularly.
Sarah, we got to leave it there for today. Thank you so much. Great to chat with you. Bloomberg Intelligence Senior Analyst Sarah Jane Mahmood. This is Bloomberg.